Harry, imagine this. You have $100,000 to invest today. But here's the million-dollar question. Should you choose consistent dividends or explosive stock growth? One path could give you a steady stream of cash flow, paying you thousands of dollars every single month for the rest of your life. While the other? It could turn your initial investment into millions. But what if I told you that by choosing the right ETF, you could have over $8 million in your portfolio and still be earning six figures annually, without ever selling a single share? That's right. One of these ETFs has historically transformed investments into multi-million-dollar portfolios, while the other is built for consistent, reliable passive income. Today, we're breaking down SCHD versus SCHG, revealing their long-term potential. And by the end, you'll know exactly which ETF can make you rich. Whether you're looking for a strong SCHD ETF review to evaluate if it's a buy, or trying to analyze SCHG average annual return, this breakdown will give you everything you need to make the right decision. We'll even cover SCHD alternatives and how covered calls could enhance returns for income investors. If you're considering SCHG competitors, we'll also explore how it stacks up against other high-growth ETFs. So let's dive into this ETF review and see whether dividends or explosive growth is the smarter choice for long-term investing. First, let's discuss the current market conditions. The S&P 500 has reached a new record high, driven by strong corporate earnings and investor optimism surrounding economic policies. The Dow Jones Industrial Average and the Nasdaq Composite have also seen gains, with the Nasdaq surging 1.28% in a recent session, fueled by AI-driven stocks. In the bond market, the Federal Reserve has kept the federal funds rate at 4.25% to 4.50%, following a series of rate cuts in late 2024. Fed officials remain cautious, monitoring inflation trends and labor market stability before making further decisions on interest rates. The technology sector continues to lead, with AI stocks pushing Nasdaq to new highs. Companies like Microsoft, MSFT, NVIDIA, NVDA, and Alphabet, Google, have reported record-breaking earnings, driving high-growth ETFs even higher. Meanwhile, energy stocks have faced volatility due to OPEC+ production shifts, while financial stocks have benefited from higher interest rates. Sectors like real estate REITs and utilities have struggled due to rising borrowing costs, making dividend-focused ETFs an attractive option for those seeking stable cash flow. With $100,000 invested today, let's fast-forward 30 years to see the potential outcomes. A growth-focused strategy, historically averaging a 15.93% annual return, could expand to over $9 million. Exposure to technology and consumer cyclical sectors provides massive compounding potential. Investors using the SCHG calculator project that, even without additional contributions, this level of growth is achievable if market trends remain strong. Now, if passive income is the goal, an income-focused approach offers a steady 3.64% yield, allowing investors to generate cash flow without selling shares. After 30 years, an investment in SCHD ETF could produce over $369,000 per year in dividends, more than $30,000 per month. For those prioritizing income generation, strategies like covered calls or monthly dividends can further enhance returns. So, the real question is, do you want to secure long-term passive income with dividends, or do you want to maximize your portfolio's high-growth potential? Investors evaluating SCHD versus SCHG must decide between steady cash flow and explosive capital appreciation, or for the best of both worlds, use a balanced portfolio strategy. Schwab U.S. Dividend Equity ETF. The Schwab U.S. Dividend Equity ETF stands as one of the most dependable options for investors looking to build long-term passive income while maintaining stable growth. Unlike high-risk growth funds, it focuses on dividend-paying stocks with strong fundamentals, making it an ideal choice for those seeking financial freedom through dividend investing. Analysts tracking SCHD news continue to highlight its steady returns and strong portfolio performance, reinforcing its reputation as a top dividend ETF. Currently, It is trading at $27.70 with a 52-week range of $25.16 to $29.72. Managing $65.552 billion in assets, the fund has proven its strength in dividend investing. Stock price fluctuations have remained relatively stable, thanks to its exposure to high-yielding blue-chip stocks. Many investors evaluating long-term investing strategies focus on its low volatility and strong compounding potential. One of its biggest advantages is its ultra-low expense ratio of 0.06%, allowing more of an investor's money to stay in the market and compound over time. With a dividend yield of 3.64% and a dividend growth rate averaging 11% annually, this ETF provides a strong cash flow opportunity for passive income investors. Looking at its performance, the SCHD CAGR has historically outpaced many competing dividend-focused ETFs, proving that long-term dividend growth can be a viable wealth-building strategy. Investors monitoring SCHD Nasdaq performance often use the SCHD chart to analyze historical trends, comparing its trajectory with broad market indexes and competitors. This high dividend-paying ETF includes top-tier companies such as Coca-Cola, KO, Pfizer, PFE, AbbVie, ABBV, and Chevron, CVX, all of which have long-term track records of stable payouts. Top holdings remain defensive and value-focused, making it an attractive choice for investors seeking predictable, qualified dividends. Now, let's look at Harry's $100,000 investment. If he stays invested long-term, the compounding effect will deliver exceptional returns. After 10 years, his investment could grow to $231,442, generating $9,700 per year in dividends. After 20 years, his portfolio may be worth $537,181, paying him over $25,300 annually. After 30 years, his investment could reach $1,247,892, delivering a staggering $65,000 in annual dividend income, enough to replace an average salary without selling a single share. With consistent dividend reinvestment, this ETF not only builds wealth but also creates financial security through predictable cash flow. Investors weighing SCHD or SCHG as part of their long-term portfolio strategy must decide between high-yield dividends and explosive stock growth. However, many choose to combine both to create a well-balanced investment approach that blends income and capital appreciation. Schwab U.S. Large Cap Growth ETF. The Schwab U.S. Large Cap Growth ETF is a premier option for investors looking to maximize capital appreciation. Unlike dividend-heavy funds, it focuses on high-growth companies that reinvest profits for future expansion. Investors evaluating growth versus dividend strategies often analyze their risk-reward profiles to determine which investment path best suits their long-term goals. Currently, the stock price stands at $28.72 with a 52-week range of $21.68 to $29.14. With a total of $37.114 billion in net assets, this fund demonstrates strong investor confidence in the high-growth sector. Its expense ratio of just 0.04% ensures that investors retain more of their returns over time, making it an ultra-low-cost choice for growth-oriented portfolios. One of its biggest advantages is its holdings in technology and consumer cyclical stocks. The holdings list includes Apple, AAPL, Microsoft, MSFT, NVIDIA, NVDA, and Amazon, AMZN, companies that dominate the market in innovation and revenue growth. Investors frequently analyze the company's list to track sector trends and long-term potential. Despite being growth-focused, this ETF does provide a modest dividend payout. The dividend history shows that while its distributions are relatively small, they have increased consistently over time. Currently, the annual dividend yield sits at 0.39%, making it less attractive for income-focused investors but still offering some passive income. Over the past decade, The KIGR has been 15.93%, consistently outpacing broad market ETFs. Investors monitoring the YTD performance have noted strong momentum, particularly due to its heavy exposure to top tech stocks. For an investor like Harry, who puts $100,000 into this ETF today, the long-term compounding effect can lead to massive wealth accumulation. After 10 years, his portfolio could grow to $441,000, generating $1,700 in annual dividends. After 20 years, his investment may be worth $1,945,000, with dividends reaching $7,600 annually. After 30 years, his portfolio could explode to $8,580,000, providing an annual dividend payout of $34,500, despite being growth-focused. With its strong historical returns, ultra-low expense ratio, and exposure to market-leading companies, this ETF is an ideal choice for investors looking to maximize long-term portfolio value. For those debating steady income versus explosive compounding potential, the choice comes down to individual investment priorities. So now, Harry, the question is, what kind of investor are you? Do you want a steady stream of passive income, allowing you to live comfortably while collecting tens of thousands in annual dividends? Or do you want the opportunity to turn $100,000 into multi-millions, riding the wave of market-leading growth stocks? Both ETFs are powerful tools for wealth building, but they take two completely different approaches. One provides reliable, steady cash flow, perfect for income-focused investors seeking financial security. The other is designed for high growth potential, aiming to multiply your portfolio into life-changing wealth. For those prioritizing stability and passive income, a SCHD ETF review highlights why it's a strong choice. With a 3.64% dividend yield, along with monthly dividend payouts, it provides a consistent income stream. Many investors use a SCHD calculator to project future returns, while others explore covered calls as a way to enhance cash flow. On the other hand, if long-term compounding and massive portfolio growth is the goal, SCHG ETF has historically outperformed many broad market funds. The SCHG average annual return makes it a popular choice for investors seeking aggressive growth, and those tracking its chart and competitors often find its tech-heavy portfolio a key advantage. But here's the best part. You don't have to choose just one. Many investors use both ETFs to create a balanced strategy, blending stable dividends with high growth potential for the best of both worlds. So, what's your strategy? Would you rather collect over $30,000 per year in dividends, or see your portfolio reach $8 million? Drop a comment below and let me know what you'd pick. And if you want to see how this dividend ETF compares to others, check out the next video on the screen now. Don't forget to hit like, subscribe, and turn on notifications so you don't miss the next big investment opportunity. See you in the next one.